What if I told you that 97% of people who try to get rich day trading stocks lose money? It's a wild number, especially when your social media feed is probably full of people claiming to be instant millionaires. I fell for that hype. Hard. I thought the only way to make real money in the market was to be glued to a screen, buying every dip, selling every peak, and just living in a constant state of gut-wrenching anxiety. I was wrong. The actual secret to building a fortune, the one that lets you sleep at night, is incredibly, almost laughably, boring. And today, I'm going to show you exactly how that boring strategy turned my tiny savings into a life-changing nest egg. Let's be real, the idea of day trading is awesome. It's pitched like some kind of high-stakes sport for money geniuses. You're the lone wolf, outsmarting Wall Street, making these killer trades and watching your account balance just explode. Who wouldn't want that? I sure did. When I started, I was obsessed. I'd wake up and my hand would immediately grab my phone to check pre-market movers. I had charts with so many lines and colors they looked like abstract art. I'd get a huge rush from a winning trade, but man, the losses were crushing. I'd literally lie awake at night, terrified that some market overseas would shift and wipe out everything I'd gained. My mental health took a nosedive. I was stressed all the time, and my focus at my actual 9-to-5 job was completely shot. And this isn't just my story, it's the reality for almost everyone who tries it. The stats are brutal. One study on day traders found that only a measly 3% made any profit, and just 1.1% earned more than minimum wage. The game is rigged. We're not playing against other people. We're playing against supercomputers that execute trades in microseconds. It's a fight we're set up to lose. On top of that, the costs just chew you up. Even with commission-free trades, there's something called the bid-ask spread, a tiny difference between the buying and selling price, that acts like a hidden tax, slowly bleeding your account dry with every single trade. I was chasing excitement, but all I got was anxiety and a shrinking bank account. I finally had to admit to myself, I wasn't investing, I was gambling. And the house almost always wins. It was crystal clear that if I wanted to build real sustainable wealth, I had to get off the roller coaster. My turning point came with a simple realization: real investing shouldn't feel like a trip to the casino. It should be systematic, based on evidence, and yeah, a little boring. The goal isn't to find a needle in a haystack, the goal is to buy the whole haystack and let it work for you for decades. The solution was to stop trying to beat the market and just become the market. This is what I call the boring is better philosophy. It's the simple truth that patient, steady investing in the broad market crushes high-risk, trendy gambles over the long haul. You trade the daily stress for the peace of mind that comes with a proven strategy. You get your time back. You get your mental energy back to focus on your career, your family, your life. This is how you actually build wealth while you sleep. It's not a get-rich-quick scheme. It's a get-rich-for-sure plan, as long as you have two things: patience and discipline. It runs on the slow, steady, and unstoppable engine of global economic growth. If you're feeling that same stress and anxiety I was, and you're ready to swap it for a strategy that actually works, do yourself a favor and hit that subscribe button. I'm all about breaking down these simple, powerful ideas to help you build real wealth without the headaches. So what does this boring strategy actually look like? It all comes down to three incredibly powerful pillars. Pillar 1. Go passive with index funds and ETFs. Instead of trying to find the next Amazon, you just buy a little piece of everything. You do this with something called an index fund or an ETF. Think of an index like the S&P 500. It's just a list of the 500 biggest companies in the US. An S&P 500 index fund is a single investment that holds stock in all 500 of them. When you buy one share of an S&P 500 ETF, you instantly own a tiny slice of Apple, Microsoft, Google, and hundreds of other companies. Boom, instant diversification. If one company tanks, it barely makes a dent because you've got 499 others picking up the slack. This immediately lowers your risk compared to betting it all on a handful of stocks. Plus, these funds have ridiculously low fees. The funds where some manager is actively picking stocks charge a ton, and those fees eat away at your money year after year. Index funds just follow the market, so they cost next to nothing. That means way more money stays in your pocket. Pillar 2. Automate your investing with dollar cost averaging, DCA. The second pillar is a trick that takes all the emotion out of investing, dollar cost averaging. It sounds fancy, but it's dead simple. It just means you invest the same amount of money on a regular schedule, like $200 every single month, no matter what the market is doing. When the market is up, your $200 buys you fewer shares. But when the market is down, your $200 buys you more shares. Over time, you end up paying a lower average price, and you automatically buy more when things are on sale. It completely removes the temptation to time the market. Let's face it, humans are terrible at this. We panic and sell when prices drop, and we get FOMO and buy at the peak, the exact opposite of what we should be doing. DCA puts your discipline on autopilot. Pillar 3. Unleash the magic of compounding and time. This pillar is where the real magic happens. Compounding is what Einstein supposedly called the eighth wonder of the world. It's simply your earnings, earning their own earnings. Here's how it works. You invest money, and it earns a return. The next year, you earn a return on your original money plus the return you just made. Over time, it creates a massive snowball effect. In the first few years, the growth feels slow. But after 10, 20, or 30 years, the curve goes nearly vertical. The stock market has historically returned an average of about 10% per year over the long run. Using a quick trick called the rule of 72, you can see how powerful this is. Divide 72 by your return rate, so 72 divided by 10 is 7.2. That means at a 10% return, your money doubles about every 7 years without you lifting a finger. That $10,000 you invest today could be $20,000 in 7 years, then $40,000 7 years after that, and $80,000 after that. This is the engine that builds your wealth while you're sleeping, working, or on vacation. Don't just take my word for it. Look, the numbers back this up in a huge way. Study after study shows that this boring, passive approach almost always outperforms the stock-picking gurus over time, especially when you factor in their high fees. Think about this. Since 1926, through the Great Depression, World Wars, dot-com bubbles, and financial crises, the US stock market has never lost money over any 20-year period. The key is time in the market, not timing the market. In fact, if you tried to time the market and missed just the 10 best days over the last 30 years, your total returns would have been cut in half. Since nobody can predict when those days will happen, the only winning move is to just stay in the game. This isn't just a theory, it's how the wealthy build and keep their fortunes. The richest 10% of households own the vast majority of the stock market. They aren't day trading, they are buying quality assets, reinvesting the profits, and letting time and compounding do all the heavy lifting. They know wealth is a marathon, not a sprint. Your 3-step action plan to start tonight. Getting started on this is way easier than you think. You can literally do it tonight in 3 steps. 1. Open a brokerage account. First, you need a place to do your investing. Find a reputable, low-cost brokerage. There are tons of great ones out there, and opening an account usually takes less than 15 minutes. 2. Automate your savings. Decide how much you can comfortably invest each month, even if it's just $50 to start. Then set up an automatic transfer from your bank to your brokerage account. This puts your dollar cost averaging on autopilot and builds the habit of paying yourself first. 3. Buy one broad ETF. And don't overthink this part. Start with a single, super diversified, low-cost index fund. One that tracks the S&P 500 or even a total world stock market index is a perfect starting point for almost everyone. It gives you a piece of global growth in one simple investment. That's it. Once that's set up, your wealth-building machine is officially running on its own. I really want to know what you think. Let me know in the comments if you've ever felt that pressure to day trade or if you're already on the boring path. I'd love to hear your story and answer any questions you have about getting started. And if this video helped clear things up for you, please give it a thumbs up so more people can find this boring but brilliant strategy. For years I bought into the lie that building wealth was all about excitement, high risks, and constant action. I learned the hard way that true, lasting wealth is built on the exact opposite: patience, discipline, and embracing the boring. Building wealth while you sleep isn't just a catchy title. It's the result of a deliberate, proven plan. By passively investing in the whole market, automating your contributions, and letting compounding work its magic over decades, you're putting your money to work just as hard as you do. You can finally step away from the screen, take back your time and your peace of mind, and build a future that's truly secure. Stop gambling and start investing. Your future self is going to thank you for it.